Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 18th of May. I'm Daniel Lam, your host for the podcast. There was much hype going into the summit between Presidents Xi and Trump in Beijing, that we saw the Hang Seng Index opening at the high, just under the 27,000 psychological level last Thursday, but closed below the 26,000 level on Friday. There was a nearly 1,000 point swing in the last two trading days of the week. Essentially, it was an event that produced modestly positive but limited outcomes without a strategic reset in US-China relations. The meeting was largely transactional, focusing on trade de-escalation and maintaining existing stance on issues such as Iran and cross-strait relationship. First of all, the trade agreements were largely symbolic. China agreed to purchase more US goods like beef, oil, natural gas, and 200 Boeing jets, although analysts see some details as underwhelming. There were promises on market access, but lacking in formal details. Now, on the geopolitical front, Iran was discussed with cautious alignment. Now, both leaders agreed upon reopening the Strait of Hormuz, and Iran should not be acquiring nuclear weapons. However, China favored further diplomacy and did not fully align itself with the US. Also, the question on Taiwan remains unresolved, and the meeting showed no sign that Trump was abandoning the US commitment to sell arms to Taiwan or support its defense. So, what does all that mean for risky assets? Well, in short, it will be back to the recent fundamentals. So for US equities, AI will still be the key driver, supported by earnings and capex. Although the semiconductors, especially those geared towards price rise rather than volume, are susceptible to pullbacks. Investors are well advised to be rotating some exposure into the internet space. Now for fixed income and FX, the recently strong US macro data and the threats of inflation should lead to sticky yields and US dollar. For Chinese equities, the disappointment manifested in the aforementioned price action for the Hang Seng Index. There was some sharp pullback in the bellwether technology stocks in Hong Kong China equities over the last two sessions. They opened high because of the hopes of positivity from the summit, but the underwhelming results means investors are back to focusing upon the heavy AI investments from these companies versus the returns that they are getting. So for now, the Hang Seng Index has strong support at the 25,500 level, while there's strong resistance near 27,000. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.